Hi, I'm Tess Downing, founder of Complete View Financial, and welcome to this month's video blog. Today we're talking about health savings accounts, or HSAs, and the triple tax break that you might be missing. So what is a health savings account? It's simply a savings account that can be used to pay for eligible medical expenses. If you have a high qualified, high deductible health plan and meet other qualifications, you may be eligible for an HSA. The purpose of an HSA is to help you plan ahead, budget, and save for any unexpected or even planned medical expenses. Although you may be unsure if it is worth it to put money towards your HSA, it is important to note that HSA funds roll over from year to year and have the potential to be used as a retirement savings tool. So let's look at this next slide, which highlights several of the advantages of HSAs. Unlike FSAs, or flexible spending accounts, which are owned by the employer, the employee typically owns their own HSA. The balances are not subject to the use it or lose it rule by the end of the year, which is a huge advantage, allowing you to roll over the contributions year over year. Most employers even offer a company contribution to help cover some medical expenses in the coming year. You can save up to $3,600 for single taxpayers and up to $7,200 for family taxpayers in a single year. HSAs cover most expenses, including medical, dental, vision, and chiropractic. I have even used my own HSA in the past to cover a LASIK eye procedure, for example. One of the biggest benefits, though, is the triple tax advantage. You may take tax and penalty-free distributions to pay for your spouse, dependents' medical expenses, and obviously your own. You can even take a tax and penalty-free distribution this year in order to reimburse yourself for medical expenses in a previous year. So one of the many benefits of HSAs is that they have 3 tax advantages. HSA contributions are either pre-tax if through an employer or tax deductible if you opened your own. You don't have to pay taxes on the account's growth. And when you make withdrawals for eligible expenses, you do not pay taxes or penalties on those withdrawals either. So here's some interesting facts on HSAs. Most plans allow you to invest your money. I always recommend to my clients that the amount above and beyond what their annual deductible is to invest. Over time, many clients have continued to max out their HSAs, but then they forget that that cash is just typically sitting there in a money market or a low interest bearing cash account. So the opportunity to invest in a well-diversified mutual fund on the back end of the HSA is a huge advantage. So don't forget to look into that if your HSA offers that option. Another few unique features of HSAs happen when you turn age 65. If at age 65 you are no longer on a high deductible plan or you've switched to Medicare, you are no longer eligible to contribute. But non-medical distributions from your HSA after age 65 are never subject to a penalty. So even if you distribute money from the HSA for something completely unrelated to medical expenses, you'll never have to pay that penalty, but it will be taxable income on those gains. Thanks for listening in to this month's video blog.